We begin in the U.S. this morning. The central bank raises interest rates again by a quarter point despite the recent banking crisis and hints at further rate hikes, meaning restoring price stability still remains the Fed's top priority. Our Lee Rae-hyun starts us off.
The U.S. Federal Reserve takes another baby step. The central bank on Wednesday raised its short-term borrowing rate by 0.25 percentage points as they continue efforts to bring down inflation. This comes despite concerns that previous rate increases helped trigger the nation's banking crisis. The rate hike brings the Fed's policy rate to the 4.75% to 5% range, the highest since October 2007. The Fed pointed to modest growth in spending and production as one of the reasons for imposing another hike. It also added that an unemployment rate hasn't remained low amid job gains in recent months, while inflation remains elevated. The Fed also rejected concerns about the financial system, saying that the U.S. banking system is sound and resilient.
We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again.
As banks rely on a central source of capital, the rapid rise in interest rates tanked the value of bonds held by Silicon Valley Bank, causing the bank's failure. Because of this, there have been speculation from some experts that the central bank might not impose another rate hike following global concerns about bank stability. The Fed has been pushing on with its aggressive campaign to tame inflation, raising the rate by 75 basis points 4 times in a row last year. Although hikes had slowed down last December and February, analysts prior to the SVB crisis had suggested the need for another giant step as inflation once again crept up and a boost in employment figures. But once SVB collapsed, experts say this 25 basis points increase is a middle ground decision for the Fed. The central bank meanwhile left the door open for further rate increases, noting that additional policy firming may be appropriate to lower inflation to the Fed's 2% target. Policymakers expect rates to tick higher this year, with the benchmark rate peaking at 5.1% by the end of 2023. Lee Rae-hyun, 아리랑뉴스.